Many people believe one simple idea: as long as the Federal Reserve prints money, every crashed asset will eventually explode higher. If you invest before the money printing starts, you don't need to work anymore. You just watch your account grow. Historically, this happened twice. Once in 2008, once in 2020, during the pandemic market crash. So when people hear, the Fed is printing money again, the question is obvious: is this the third time? But the real question is this time actually the same? Let's start with a basic fact most people ignore. Banks do not mainly hold stocks or real estate. They hold US Treasury bonds. Because they are considered safe. Because default risk is low. But here is the problem. When banks buy government bonds, their money becomes locked. Cash turns into bonds, and locked money cannot be lent freely. When banks lack cash, everything slows down. Companies cannot borrow. Households cannot borrow. Mortgages and credit tighten. Businesses fail. People default. Even banks themselves face stress. This is how economies don't decline slowly. They stall suddenly. This is where QE is misunderstood. Quantitative easing is not the Fed giving banks free money. What actually happens is simple. Banks hold bonds but lack cash. The Fed prints money and buys those bonds from banks. Bonds go to the Fed. Cash goes to the banks. Liquidity returns to the system. That is the real purpose of QE. Today, the Fed says it buys around $40 billion of short-term treasuries per month, plus another $15 billion redirected from other facilities. That's roughly $55 billion monthly. Is that balance sheet expansion? Yes. So why is the market so calm? Because the name changed. Before, buying long-term bonds was called QE. Now, buying short-term bonds is called something else. Different label, same action, money printed, bonds bought. In the past, QE was loud. It told the world, borrow, invest, take risk. This time is quiet, because this expansion is not about growth. It is about preventing system failure. Here is the key difference. In 2008, rates went to zero. In 2020, rates went to zero. This time, rates are still around 3.75%. Why not zero? Because long-term bonds have few buyers. Yields are rising, not falling. Long-term bonds only become the safest asset during real financial crises, when risk assets collapse. So the message is clear. This round of money printing is not a signal to chase assets. It is a signal to stabilize the system. It is survival mode, not a wealth generation phase. Real QE comes only when real crises arrive. If this helped you understand the system, like the video and subscribe to the channel. In the next video, we'll talk about Japan's rate hikes and how they drain global liquidity.